NST. By double clicking on that particular stock, that will open up the chart of NST. Now, you can see here at the moment, we've got this red line that moves upwards and it also moves downwards as well. Sometimes the price is below it. Sometimes the price is above it, and below it, and above it, below it, and it's just moved out above it. In this particular example, we've got what's called an ATR breakout. So ATR stands for average true range. Now, average true range is just a form of an indicator. And the indicator calculation is calculating the average true range. So the average true range is, the simplest way to describe it is the average trading range. So that is from high to low. So if I zoom in on part of the chart as an example, in this case, this green bar in the middle here has an open, a high, a low, and a close. So when we're looking at price on a chart, the highest point is the top of the range. So that's the high of the day. The lowest point of that vertical bar is the low. The little notch on the left-hand side is the opening price, and the little notch on the right-hand side is the closing price. So on any particular day, we get to see the open, the low, the high, and the close. Now, the trading range on any given day is just the difference between the low and the high. That's the trading range of that particular day. Now, the average true range or average trading range is taken over a 21-day period. So what it's doing is it's looking at the average range, so from low to high on each one of these bars over 21 days, so over 21 bars. Now, it's averaging that trading range, but it's also including these gaps. So this range between the close here and the open of the next day, it's using that in the calculation as well. So that's what's called the average true range. So it's averaged over 21 days. So it's adding all those trading ranges together, and then it's dividing it by 21, and it gives us what's called an average true range. It's a measure, if you like, of the stock's volatility. So if a stock has an average true range, an average trading range of 50 cents, as an example, then it's telling us that on any given day, the stock is likely to move 50 cents in either an upwards or a downwards direction. Okay, so if you were to compare that with a stock that had an average true range of $1 upwards or downwards, you'd start to get a little bit of a measure of how volatile the various stocks are. So it's just one form of measurement of volatility. So remember yesterday we talked a little bit about the personality of a stock and how we like stocks to have a different range of personalities, different moods along the way, rather than being, a crazy maniacal, highly volatile stock throughout its entire life. We like stocks to be able to trend, but also to behave in certain bands of volatility, that is, certain moods along the way. Yeah, BO stands for breakout. That's right, Joanne. Moving average. So yeah, so it's the volatility. So that ATR, it's a moving average. So each day, as we get an extra bit of data, so it's a 21-day average. So it takes the last 21 days, and then as we get one more day of data coming in, it chops off that first one from the original 21 and adds on the new one. So it's a moving 21-day period average of the true range. Okay, so it's just, again, we're getting a little bit technical, but hey, if people have got questions, I think it's good to go in and find out some of those technical aspects as well, because we're all curious and we all like to know how this algorithm, for want of a better word, how this system actually works. So without giving you all the components, I'm happy to explain how the actual cogs fit together. Okay. And if it's something that so interests you, you can actually go off and research some of the elements yourself. So we're talking about this average true range. So if we get back to our example and just say, look, this is a stock that has an average true range of 50 cents. So on average, it fluctuates in price by 50 cents upwards or downwards. So if we think about it, if we wanted to have a protective measure, a safeguard where we could be in the market but not be too close to that price, how could we use that average true range, that current assessment of the stock's volatility, its mood, how can we use that to determine where our exit might be? Have a think about, if you've ever been on a farm, have you ever seen a bull in a paddock as an example? And you see a bull and it's just calmly sitting there on the paddock chewing some grass. And you walk up to the fence, you poke your head over and the bull looks up at you. And you think, well, that's quite a big bull. I wonder what sort of a mood it's in. Well, if you happen to know that the bull had its head down and starts snorting, flaring its nostrils and stamping its foot, you might say, well, look, I'm glad there's a fence here. Because if I was to jump over the fence, it might be that bull might, start to look at me, might start to walk towards me. So that bull's going to have a safety distance at which, if we get too close, we're in danger of being charged. Okay. So we want to make sure that we don't get too close to the bull in this particular example. So it's a safety net. So if we know that the safe distance on any given point in time is that the bull's going to move a couple of meters this way or a couple of meters that way, then personally, I'm going to say, well, look, if I know that it moves 2 meters this way, then I'm in the danger zone. Then I'm going to say, well, look, you know what? I'm not just going to give it 2 meters. I'm going to give it 6 meters. I'm going to give it 3 times that danger zone distance. And that's where I'm going to park myself, because I don't want to get too close to the bull. Now, the bull's got to eat grass and, be able to live and move around and do what bulls do. And so from that point of view, I just want to make sure that I get to participate in the farming experience. I've got my farmer's hat on here, that the bull's going to be happy and I'm not going to get too close. So it's a similar sort of concept. Another analogy in terms of how this trailing stop works is, if you can imagine, you've got youngsters and they're wanting to learn how to climb a tree. And they say, Mum, Dad, come and watch me climb the tree. And the first thing you say is, you be careful out there, all right? Don't you climb too high. And you're saying that because you're worried what's going to happen if they fall. And so there's a natural tendency, if your children are climbing trees, is that you go over towards the tree. And as they're climbing up the tree, you as a parent, typically just straight out of reflex actions, etc., is you put your hands underneath them. And as they go up a little bit higher, what do you do with your hands? You move them up a little bit higher and a little bit higher as well. Okay. And so that's where the idea of this trailing protective stop comes in. So as your child in this particular example climbs up the tree a little bit higher and a little bit higher, for safety, we're moving our hands up a little bit higher and a little bit higher and a little bit higher. Okay. And you'll note that the trailing stop loss never ever comes down. Okay. So if the child's climbing up the tree, we don't want to move our hands down. We want to continue to move it up, our hands up, whilst the child is still climbing the tree. Okay. And if they stop climbing the tree for a while, have a rest, what do we do with our hands? They just stay there and have a rest as well. Okay. So that's the sort of adaptive mechanism that is behind this trailing stop. Yeah, AT is an indicator. It's an average true range indicator, and it's based on price action. Okay. So it's a measurement of a stock's volatility. That is the potential for a stock to move in any given direction. And it will ebb and flow. Okay. So depending on its volatility, and the way that the indicator works is that it knows that there are specific bands of volatility. Now, husbands and wives, partners, we all know what our opposite partner is like in terms of their personality, and you will know that they will have their own bands of volatility, their own particular moods. And you will know that when your partner, your friend, your spouse, whoever it may be, your children are in a stressed out mood, let's call it that. And you'll know to give them a little bit of peace and quiet to keep your distance. Okay. But there'll be other times when it's really nice where you actually can get a little bit closer. Okay. So we know that from a personal human point of view, the same thing is occurring in the background with this indicator. It adapts on the run. Okay, so it knows when a stock is reducing in volatility and being quiet. And so therefore, if the stock is in a quieter mood, then our average true range, our little red indicator, often referred to as a leap indicator, can get a little bit closer. Okay, and by doing so, by reducing the distance from where our hands are, so to speak, to where our child is in the tree, we're reducing the risk because we're getting closer. Okay. And so that's what we're looking to do. And that's what this indicator is looking to do along the way.